Speaking next, at the second day of the Asia PE/VC Summit is
Nicholas Bloy, co-founder and managing partner at Navis Capital Partners. So Navis Capital has a history of over 2 decades, primarily investing in ASEAN countries. The firm now manages over 5 billion in terms of assets. We are thrilled to have Nick here today to talk about the fundraising and also exit prospect in the post-COVID world. Nick, welcome.
Thank you.
To start with, I have a perennial questions, but I think it's still valid now. It's about the dry powder in this region. So you may know that the dry powder is still keeping increasing. And actually, our own data product has shown that in 2020 alone, there was $1.4 billion US of capital raised via interim closes. And then there were 25 Southeast Asia focused funds in the market to seek $5.8 billion US, let alone APAC funds with a Southeast Asian allocation. And at Navis yourself have closed 2 new funds, right? So with all of that dry powder available to be deployed, do we expect to see record deals in the rest of this year and next?
Well, we definitely will see increasing deal volumes and deal values because of that extra liquidity that's coming into the private markets space in Southeast Asia. But that's not really a problem because, first of all, the industry remains very immature by most benchmarks compared to other parts of the world. And so an acceleration of deal volumes and deal values is to be expected. And of course, the region itself is also growing very fast and faster than most other parts of the world. And so that combination of growth and immaturity creates a logical need for private capital and more of it. And so, having more and more dry powder and getting that deployed is simply part of that natural evolution of the market. And I don't see it as a particular problem at all. I just see it as a feature of, being in a really interesting part of the world where and a function of the combination of immaturity and growth.
Mm-hmm. But that said, it comes down to the manager's ability to sourcing for attractive targets. Now, people might debate that the current volatile environment it make it hard for them to evaluating deals. But then yes. There can also be chances for us to separate the wheat from the chaff, right? What's your senses about this? And how can you make sure now when you're going to a deal, you get the right entry price?
Okay, I think that because of COVID, there has been difficulty for many managers to either source or to do their due diligence on deals, right? And that slows things down, and that means dry powder builds up a bit more as other fundraisings are sort of happening elsewhere in the market. I think that's a relatively temporary phenomenon. But one of the things it has done is it's caused a diversion of liquidity into those deals that are easier to diligence. And so, in my opinion, you've seen a much greater flow of venture and very early stage growth deals because they're much more easy to diligence. Often they're in the digital space. So there isn't a factory to go and visit, an equipment to go and sort of validate and so on. So in terms of, lending themselves to virtual due diligence, deal flow that's in the new economy and much earlier stage is probably easier to do. And so you've seen people sort of, I think the proportion of such deals has grown during the COVID period. But I think that will change, and we'll get back to a mix where exciting but more real economy businesses, which might be spread over several geographies, which of course right now are difficult to diligence physically in Southeast Asia. We will start to be able to address those kinds of deals probably later on this year or starting early next year. So there's been a bit of I would say the consequences of the travel bans of COVID. Have been to slightly, bring up certain types of deal that are easier to do and suppress others that are less easy to do. But it doesn't mean that they won't get done in due course, because those entrepreneurs and those founders who are trying to grow their businesses, they still have the same needs for capital and so on. So the need hasn't gone away, and it will come back big time, I think, next year.
They might be under a little bit of stress, and there might be some kind of impacts to the valuation of the business. So people would argue that you might get a better price, maybe cheaper assets. But is that really the case?
Well, to be honest, I don't think that that's a great opportunity. I mean, there is distress, obviously, in the parts of the economy that have been affected by COVID. So anybody who's in retail, brick and mortar retail, other than those kind of emergency types of retail like supermarkets and pharmacies and so on, but anything outside of that will have had a very tough, 18 months or so. But I think that any vendor of those businesses will not simply roll over and say, well, I'm going to accept a multiple on my COVID impaired EBITDA. And they'll just say, no, you have to normalize COVID out. And so I don't see that there will be, there'll be more bargains than there have been historically. I mean, I think that Southeast Asia remains relatively undervalued compared to other jurisdictions in terms of entry multiples for deals. But that's more a function of the lack of really professional intermediation in the market, and the fact that certainly in Southeast Asia, it's a very big economy, well over $3 trillion with not that much dry powder, frankly, to go around. And so that's the conditioning factor, or the factors that mean that entry multiples are relatively lower. And I don't see them becoming bargain basement, unless maybe in some companies they're so beaten up they really ought to, go bankrupt. But those are very isolated examples. And no vendor who's been able to hold on through COVID is going to price his business on a COVID impaired amount of EBITDA. He's just not going to transact. Why would he?
Yes. So given that borders are still closed in many places, not just Southeast Asia, but around the world, it can be a good time for Southeast Asian managers to focus the resources on the ground than to have access to better deal flow instead of investing elsewhere. Meanwhile, Navis, when you made the announcement of the new funds, you said that you plan to invest in Australia, New Zealand, and Greater China too. I understand that you have offices in those regions, but why not boost your current presence on the home turf? And then what are the plans for investment in Australasia and Greater China?
Well, this is not a new geographic mix for Navis. We've been investing in Australia and New Zealand for about 20 years, and also in sort of companies that are headquartered in Hong Kong or Macau, for example, also for about 20 years. But it's a relatively smaller part of the portfolio, but our investors are used to having it in the portfolio as perhaps 15 to 20% of the overall geographic mix. 3/4 of the funds will always be and have always been in Southeast Asia. And we don't particularly see the need to change that. I would say if there's one geography where we, because of travel restrictions, we're probably going to do less for the time being, it's going to be, Hong Kong, China itself. Because it's quite hard to, even if the company's head office is in Hong Kong, and very often it's part of an industrial ecosystem that is in China itself and also partly in Southeast Asia. And it's relatively hard to diligence a business that is part of a multi-country ecosystem. But for Australia itself, we have and New Zealand, we have an office in Sydney that covers both those geographies. You easily travel between Australia and New Zealand. That's not an issue. And in Southeast Asia, we have 4 offices. We have Kuala Lumpur, Singapore, Ho Chi Minh, and Bangkok. So we actually have physical coverage on the ground in some of the most important geographies in Southeast Asia. So it's not really, I don't think we need to double down or just restrict ourselves, in some extra special way to Southeast Asia because of COVID. I think that would be a bit short term in thinking.
Yeah. Yes, but for a Southeast Asian focused fund managers, it doesn't sound really common for a fund to, expand into countries, markets like Australia and New Zealand. So,
yeah, but what I was trying to say is we did this 20 years ago. It's not a new thing. It's a part of Navis's history. We have really good returns there. It's something that investors are used to seeing in our portfolio. And actually, in particular, one of the reasons for it is because there is the possibility to make great returns out of exploiting commercial linkages between a company, let's say in Australia, and bring that company into Southeast Asia and or Greater China, which, frankly, for Australian management teams is culturally very challenging. And actually, in fact, almost all of the GPs that are particularly focused, on Australia itself, none of them have a network in Asia. So we feel that there's a niche that Navis can fulfill in Australian and New Zealand deals, which is where, the future value creation chapters for that company lie in succeeding in Asia. And we will exploit those linkages. So we're not really going to do a deal that is, a pure domestic roll-up, in Australia, which has got nothing to do with the rest of Asia. I mean, there are other people who are equally equipped to be able to do that. But when there's a strong need for commercial penetration of Asia, I think that we're uniquely positioned in the mid-market to deliver that. But I just want to reiterate, this is something we've been doing for 20 years. We haven't suddenly made the decision to stop investing in Southeast Asia and start going into Australia and New Zealand. Far from it. These decisions, this evolution of our footprint started 20 years ago.
So you said that the investments in Australia and New Zealand have generated good returns for you.
Yes.
Yeah, can you shed some light on is it better than the opportunities in
It's
Southeast
about
Asia?
the same, actually. It's about the same. Particularly when they became particularly good when we set up our office in Sydney, because the initial deals were done, when we were still headquartered in Kuala Lumpur, which is quite a long way away. And I think it's generally true, and it was true for Navis as well, that if you're making investments a long, long way away from home and having to fly in to do them, you often make more mistakes than would be the case if you're operating with, people who are on the ground permanently. They're part of the ecosystem, they're part of the culture, and so on. So I think our very first deals in Australia in the early 2000s, it was slightly patchy. We had a good one, we had a not so good one. But ever since we set up the office there with a former BCG Boston Consulting Group colleague of ours, Navis came out of the Boston Consulting Group effectively, and a former colleague of ours joined us to head up that office, Phil Latham. It's been really good and comparable to the rest of the portfolio.
Yes. So Nick, you've closed the eighth fund at $900 million. So it's still among the largest ASEAN-focused funds, but it was below your initial target of $1.75 billion US dollars. And meanwhile, you also launched the CME fund, which will invest in the sub-Mekong region, which has not, received the spotlight as other markets, perhaps except for Vietnam. And then you have the continuation fund. So what have caused to the decision of closing the fund under target and then come up with the, different strategies instead of seeking approval for combining all in one?
Okay. I mean, with regard to the flagship fund closing at $900 million versus the original target of 1.75, the 1.75 was a number pre-COVID. And it was building on the predecessor fund, Navis 7, which was 1.5 billion. So 1.5 billion, a modest escalation to 1.75 billion because of growth in the region and so on, seemed like a reasonable proposition. And that was in 2019. But when we came into 2020, very early in about March or April, we realized, well, people aren't going to be able to travel, at least for 6 months. We didn't realize the travel difficulties would extend for so long and still extend. But we almost immediately brought the target down to 1.25 billion, still assuming that travel and the ability to do physical due diligence would start again before the final close of the fund. But I think at the beginning of 2021, we kind of realized, well, these travel bans are really going to extend for quite a lot further into the future. It's not a 6-month problem. It may be a 24-month problem. And we just decided, look, we've got to just close the fund at whatever it's going to be and get on with the investments rather than, trying to give people more time and so on. Frankly, it's not fair on your initial investors to keep a fund open for a very long time because, in a sense, they've taken the early risk. They've got an exposure to the early deals. And if those early deals are going really well, which they are in our case, then for people to come in, 18 months or 2 years later and dilute them, which is the mechanics of subsequent and final closes. If you wait too long for that, it doesn't seem like you've done the right thing for those early investors. And so we kind of said, look, no matter what it is, we're going to have a final, close date of this date. Whether travel has started or not, doesn't matter. We'll just close what we can and get on with it. And the consequences are, of course, that we will have a slightly more concentrated fund size. I mean, normally we invest in between sort of 15 to 18 portfolio companies per fund. I think we can still get pretty good diversification out of, 10 to 12. And in fact, some of our earlier funds were even more concentrated than that. I think our first fund only had 7 portfolio companies in it. So I think we accommodate this change of size by a slightly more concentrated portfolio. And also we'll probably get the money deployed a bit faster than would otherwise be the case. And so we'll be raising Navis 9, which would be the successor fund to the fund that we've just closed, maybe earlier than would otherwise ordinarily be the case. So that's the sort of the situation there. With regard to the CLMV fund, well, I think that that region in Southeast Asia is the most emerging region. And actually, when the founders of Navis first started their careers in Southeast Asia, which was in the 1980s, some of the more developed economies today in Southeast Asia, like Malaysia and Thailand and so on, they were very much at the same stage of development of the CLMV geographies today, 30 years ago. And what we've been able to observe by living and consulting and investing in these slightly more developed Southeast Asian markets are certain patterns of economic development, which leads to great opportunities in specific segments at specific moments in time. And we felt that we had an accumulation of 30 years of knowledge from, let's say, Malaysia and Thailand, just to take 2 examples that are more developed on a GDP per capita basis. But we're at the same level as CLMV is today, 30 years ago. And we can take that knowledge and rather cherry pick sectors that are both of commercial appeal and also of social impact. I think that's also something that has become part of the way Navis thinks. And we know that there's a subset of the universe of LPs out there, the DFIs, who are looking to have fund managers effectively deploy capital in a fiduciary way, in a sensible way. And we felt that we were uniquely positioned as the one Southeast Asian focused manager that's been doing it for longer than anybody else, that we should take the lead on doing something like this. And of course, those DFIs, they're not so interested in the part of Navis that's investing in Singapore or in Malaysia or Thailand, because those geographies are now too developed for their mandates. And so we can't address the needs of the DFIs with our traditional product, but we can address it with a focused fund. I think that today Southeast Asia is becoming a little more sophisticated, and where you can have slightly more specialized funds in a way that wasn't so obvious 10 or 20 years ago. 10 or 20 years ago, I mean, because it was so immature, deal flow was so thin, you couldn't just say, well, I'm just going to do healthcare, or I'm just going to do education, or I'm just going to do MES, because you had to do a little bit of everything to really construct a really good portfolio. But now that it's developed, first of all, I think fund managers have the opportunity to develop specialized strategies by industry vertical and by type of asset class. And I think that LPs themselves are looking for increasingly granular opportunities to plug into, as opposed to saying, oh, I want very broad Southeast Asian exposure. I don't really care which industry, what asset class, I just want to throw some money into it. I mean, I think those days have gone. There's a lot more sophistication out there. And I think then as a fund manager, you have to lead that opportunity by providing much more segmented and specialized strategies to LPs to take a look at.
Yeah, so that's also include the continuation strategies, right? So you said that the region is getting more mature in terms of developing a lot more types of strategies. For secondaries, I mean, because it's still early in Southeast Asia, so people would tag the type of secondary funds along with the, a poor exit environment. So what's your sense about that? And could you also give us a sense of the kind of assets that Navis will continue to hold in your new continuation fund?
Yeah, so the continuation fund really came into existence for two reasons. One is we were planning to exit every investment that's in the continuation fund in 2019, 2020, 2021. That was our sort of 2018, 2019 commitment to ourselves and to our LPs. And it for those particular companies, or not all of them, but for particularly the companies that ended up in the new continuation fund, the Navis Green Loop Fund, it's called, we simply couldn't get them done because they were in industries that couldn't be diligenced. Some of them are in, one of them, which is in our environmental and electronic waste management services business, is in something like 35 countries globally, or it's headquartered in Singapore. It's just but we're in Vietnam, we're in Philippines, we're in Australia, we're in Japan, we're in Europe. It's impossible for anybody to really have diligence that. And so you either have a choice, I think, when you come to the end of a fund, which has still got some assets, which is you say, well, look, do I just kind of sell them no matter what, or do I distribute equity in those businesses in specie to LPs? So instead of giving them cash, you give them shares in proportion to their ownership of that deal through the fund. Neither of which is very satisfactory, frankly, because you have to sell at a fire sale price if you're going to give them cash. And if you're going to give them equity, you give them a problem, because then they've got to figure out, what do I do with this 1.5% of these companies? And they don't really want us to do that. But also, if you have a theme or a belief that, as we do for the companies that we put into that continuation fund, that we're at the start of a very interesting wave of opportunity for green companies, broadly defined, we're just at the very start of it. And if we had 5 more years to really drive growth in these businesses, we're going to make tremendous returns. To me, that's the more important factor behind this. It's not so much that we couldn't exit, although we would have liked to have exited had COVID not come around. It's just that the opportunity, or the opportunities for these companies, is incredible. I'll give you a couple of examples. So TESS, which is our Singapore headquartered electronic waste management business, has for many years developed a global recycling capability for lithium-ion batteries, which have come out of its mobility clients. So lithium-ion batteries, of course, are in our cell phones and in our iPads and so on. And so for several years, we've developed processes and software that allows us to safely recycle some of the valuable materials in lithium-ion batteries. So we've had that capability for a while. But when you see the rise of electric vehicles, you suddenly realize that the volume of material that is going to need to be recycled is going to go up by a factor of 10 or 50, because a car has hundreds of times more lithium-ion battery capacity in it than an iPhone. You realize, wow, we're an early mover into a space where demand is going to explode over the next 10 or 20 years. And so that's something that we wanted to take advantage of. We have another business called Cladtech, which is in a sort of specialty pipe lining business that historically has gone into the oil and gas industry. So when you produce oil and gas, it obviously comes out of the ground in a very sort of caustic way. And you need very specially lined steel pipes, which won't deteriorate because of the caustic nature, the corrosive nature of some oil and gas, some hydrocarbons as they come out of the ground. And we've always liked that business because it was a technology leader. It has the lowest carbon footprint of any steel pipe producer, but it was still, serving the traditional oil and gas sort of production segment, which I would argue is, going to be in decline for a while. But what's interesting is now we can start to see a second life for many oil and gas fields, which is the use of those fields for carbon capture and storage, where you need pipes to start pumping carbon down into the ground. And that can also be corrosive, and it needs a special type of pipe. And so we can pivot this business from being, I would say, part of a dirty industry into part of a much greener industry, which is effectively, the creation of blue hydrogen, where you have to do something with your carbon and it's getting re-injected deep into the ground using, oil and gas assets, or in many cases, oil and gas assets that otherwise would be coming to the end of their life with a liability associated with them, but they have a second life. And that's something that I think we can take advantage of. So those are kind of examples of the opportunity that we saw and we continue to see. And that gave us the feeling that rather than just trying to run for the door with these companies, we should have a good 5-year run, because we will make a lot more money by doing that.
Apart from the particular examples, then will the the longer holding period affect the returns of the investment?
Well, I don't think so. I actually think it'll improve the returns, because imagine selling at a fire sale price this year, when because of inability to do due diligence, you sort of sell for whatever you can get, versus a time when due diligence opportunities are normalized, and when you've gone through a period of hyper growth, I think the returns will be better, actually. So I'm not particularly worried about that at all. I'm really thrilled about the opportunity.
Yes, but as we're talking about exits and returns, I think a related issue is the unrealized value that is existing right now in Southeast Asia. So public data can point us to an amount of up to 25 billion last year. So is it a pressure on fund managers to make exits? Because we have to focus on addressing that whopping number before the LPs can make new commitments.
Yeah, I think so I think you're just to start with, I think that 25 billion number is actually not a whopping great number. I think it's a very small number in the context of a $3.5 trillion economy. What's much more relevant, I think, and what factors into LPs' minds is the DPI of the funds in which they've invested, which is kind of saying, well, look, I've given you this much cash. How much of that have you given me back? Right? How much have you distributed back? And I think that because exits have been harder to come by, for most people, not all people, there are some sectors where people have actually been able to exit quite well. I might explain that in a little while. But for the most part, DPIs have lagged expectations that were set pre-COVID. In other words, so in Navis's own case, we'd have said, look, here's our exit timeline for these businesses. It's realistic. We've appointed advisors. everything's moving that direction. And we expect to generate this much cash. And so the DPI will go up like that, right? These are every LP has those expectations of its fund managers. And then because of COVID, exits didn't happen, got delayed, and so on. So the DPI number, instead of going like this, has gone like that. And so they do expect to that number to accelerate and catch up to a certain extent. But it's not the size of the number that's the issue. That will get easily absorbed by the market when people can travel and do the normal things that they have to do as fiduciaries. So to me, that's the issue. It's not the whopping size of it. It's not that whopping, in my opinion, at all. But maybe I'll just also comment on the fact that some fund managers with certain strategies have been able to have exits that have been quite good. So when a fund manager, I'd give you two situations. When a fund manager is a country-focused fund, and so his portfolio comprises purely domestic players, right? You could have a Thai fund manager that has a portfolio of Thai companies, and they're only in Thailand.
Yeah.
Well, if the buyer universe for those companies in Thailand are also Thai companies. So the buyer is the vendor is in Thailand, the asset is in Thailand, the buyer universe is in Thailand. Well, there's nothing really to stop a transaction going ahead there, right? Because people can do their due diligence and so on for the most part. So fund managers with that kind of approach have had a relatively easier time of exiting. And then the other situation, which I've seen and been quite envious of, frankly, have been fund managers that have minority stakes in more sort of early stage growth companies, where either they can sell to the next round of buyers, because again, a lot of for early stage and particularly digital businesses, due diligence is much less physical. It can be done much more easily remotely. Or if they've got a business that is sort of domestically focused or regionally focused, and it can IPO on the local stock exchange. And again, if you're a minority investor in private equity, it's relatively easy to invest at the time of an IPO. Whereas for Navis, it's difficult because we always control 51, 60, 70% of our businesses. So we've never IPO'd. We've had a history of something like 55 exits, but we've never IPO'd any of our businesses because we're always the supermajority controlling shareholder. And if you try and IPO such a business, the market isn't stupid. It knows that ultimately, because you're private equity, you're going to sell down to the public markets to zero as fast as you can. And then with that big overhang, often you don't get the liquidity or the pricing that is attractive. But if you only own 10 or 20% of a company, and it's got a controlling shareholder that's going to continue growing the business and so on, and it goes for an IPO, well, you can get out of those businesses. And I would say that in Malaysia, for example, Creador has done a really good job with that kind of situation where they've got a good minority stake in a great business. It's in Malaysia. It's able to list on the Malaysian Stock Exchange, and boom, they've been able to create an exit. But those are relatively, in terms of the 25 billion, if you want to talk about it, those are relatively small amounts of money that are where there hasn't been a big COVID impact on the ability for buyers to do proper due diligence.
Yes, but I think this time the global crisis is a health crisis, so it's different. I remember you had an interview, I guess, 10 years ago, where you say Asia had gone into the global crisis in a much better shape than any other parts of the world. But now this is a different crisis. So do you think that it will, create really traumatic effects that the region can no longer use its conventional strength to, mitigate the risks?
Well, it is a healthcare crisis, and it's a global healthcare crisis. But I don't think it hasn't led to a widespread economic crisis, and I don't think it will, because I think policymakers understand the unique circumstances of the situation, and they have obviously kept interest rates very, very low and provided massive, credit throughout the system to individuals, corporates, and so on. And so I don't really see the ingredients for an economic crisis at all. Of course, specific sectors have been hurt, right? Restaurants, cinemas, those traditional sort of brick and mortar businesses. But the demand will come back for that. And Southeast Asia has always been one of the most important factories to the rest of the world for goods and services that the rest of the world needs, along with China. And actually, the geopolitical issues between China and the rest of the world are probably only going to get worse. And so from the export-oriented part of Southeast Asia's economies, that really is a good thing fundamentally, because we already see it in our own businesses. Supply chain managers in the US and in Europe are looking to diversify their sources of supply and not be totally reliant on China. And the next biggest and most competitive industrial ecosystem to the rest of the world is Southeast Asia. For sure, it's way ahead of LATAM or Mexico or Eastern and Central Europe in terms of its ability to supply much of what the world needs. So to me, I don't really feel that Southeast Asia has got much to fear coming out of COVID. We see massive pent-up demand and we see that demand bounces back really, really quickly when economies unlock and normalize. They may lock up again. I mean, we're not yet fully out on a glide path away from COVID. So we may still have some opening, closing. When markets close, of course, demand gets compressed. But then when it opens again, it expands and bounces back out again. But I wasn't very worried about Asia or Southeast Asia when the global financial crisis hit, that you're referring to an interview back then. And I'm not very worried about it now, frankly.
Mm-hmm. I also want to hear your views on the dynamics across sectors. So the pandemic, we can foresee whether it will end. And so because of that, technology has become a great, really attractive asset class for even large PE investors. So if we look back just 2 years ago with the WeWork or Uber fiasco, and people were just all shaken about the developments. But now the VC guys and even the PE guys seem to move on really quickly. Do you think that the tech trend will be sustainable? And for the more traditional side of business, how will they retain their shine as an investment opportunity?
Well, I think every fund manager has a fiduciary responsibility to find the best risk return opportunities out there that are broadly consistent with their mandate. And frankly, it's not surprising that people have gravitated a bit to earlier stage growth companies and away from leverage buyouts. Leverage buyouts are typically of much more mature companies, much more brick and mortar companies, and so on. And COVID has, for the most part, compromised their cash flows in the short term. They'll come back, but they've been compromised. So very hard to predict around putting together the mechanics of an LBO for a business that's COVID affected and perhaps which is relying on external demand in the US and Europe. How quickly will demand recover? I mean, right now we can say that it's very fast, but how fast will it get well above COVID levels or not? So there's risk associated with doing traditional deals, or there has been for the last 18, 24 months. Whereas there's less risk in doing deals in the digital economy, many of which have thrived because people's behavior has changed. People are much more comfortable shopping at home. E-commerce forms have proliferated, even the Zoom platforms that we're using in lieu of travel and so on. Again, you can very clearly see that, wow, demand is rising. These companies are, they're no longer just perennially loss-making businesses, but they're actually, at the unit level, they're making good money. And even at the whole enterprise level, they're starting to make money. And so as a fiduciary, you start to say, well, that looks really, on a risk return blended basis, it looks really quite attractive. And so why wouldn't you start to migrate some of your portfolio in that direction? And then I think for you talked about how older economy companies can restore their shine. Not all of them will. I mean, many of the technologies that are being rolled out are disruptive. And with disruption, there are winners and losers. And so there will be losers in the old economy where people really won't make a great return, or the returns will be very, very pedestrian. And I think you just have to be really smart about understanding, okay, is this a niche that is being disrupted? Yes or no? If yes, can I harness that disruption in a way that helps this brick and mortar business become stronger? Because not all businesses that are disruptive are totally digital. They can be a combination of digital and brick and mortar. Or is it an industry segment where actually the brick and mortar guys are just going to basically all die? And then once you've made that assessment, you can start to decide, well, what should I avoid? What should I be interested in under certain circumstances? And what should I be very enthusiastic about? It's triage, it's segmentation. It's understanding the basis of competitive advantage and looking at industry dynamics that will lead you to a sensible answer. But I don't think we think that the world will 100% go back to the way that it was pre-COVID. It's moved on and people's behaviors have changed. And they will remain changed for many, many things.
All right. So a few takeaways from the conversation today. We are sitting on a huge dry powder in the region, and we will expect to see more deals coming up in the next, let's say, 18 months. And we don't really have to worry about the unrealized value in this region. And the investment community also have to adapt to the post-COVID world, and it's actually a good sign, right?
Definitely. Creative destruction is a great thing if you're on the right side of it.
All right. Well, and I think that comes to an end of this session. Thank you for being here today and sharing with us the insights, Nicholas.
It's a pleasure. Thank you, Ngoc.
Thank you.